Imagine a September morning in 2008. Wall Street, the beating heart of global finance, suddenly convulses with a headline almost no one dares to believe. Lehman Brothers, a 158-year-old investment bank, has declared bankruptcy. A name that had survived the U.S. Civil War, 2 world wars, and countless economic crises collapsed within days of panic. Thousands of employees walk out of the Manhattan headquarters carrying cardboard boxes. Global markets plunge into chaos. In a single moment, it feels as if the entire financial system has lost one of its pillars. You've probably heard of the 2008 financial crisis, but few know that Lehman Brothers was the spark that ignited the inferno. Why did the U.S. government step in to rescue AIG and Bear Stearns but let Lehman fail? How could an institution so old and seemingly untouchable fall apart in just a few days? And how did that decision ripple across the world, shaking economies from America to Europe and Asia? This story isn't just about a single company going bankrupt. It's about the arrogance of Wall Street, the blind spots of financial oversight, and fateful decisions made behind closed doors. It shows how a too-big-to-fail giant can collapse when built on risk and greed. More importantly, it reveals timeless lessons for today's investors and economies, because new bubbles may already be forming, unseen. Prepare to dive deep into the rise and catastrophic fall of Lehman Brothers, a financial tragedy that changed the world forever. To understand why Lehman's collapse shook the world, we need to rewind back to the 1850s when 3 German immigrant brothers arrived in America with little more than ambition. Henry, Emmanuel, and Meyer Lehman started a small fabric store in Montgomery, Alabama, serving cotton farmers. But cotton was America's white gold, and the brothers soon realized the real money was not in selling goods but in financing trade. They began lending to farmers and trading cotton notes, planting the seed of an investment banking enterprise. For more than a century, Lehman Brothers adapted and survived. They financed railroads, supported industrial expansion, and outlasted the Civil War, the Panic of 1907, and even the Great Depression of 1929. After World War II, they shifted toward securities trading and financial advisory, eventually becoming one of Wall Street's Big Four alongside Goldman Sachs and Morgan Stanley. But the 1980s-1990s transformed American finance. Deregulation and innovation created new profit frontiers. Lehman dove into riskier waters: mortgage-backed securities, MBS, collateralized debt obligations, CDOs, and commercial real estate investments. It was the era of booming housing prices and faith that home values would always rise and that complex financial engineering could magically spread risk thin. Unlike commercial banks, Lehman was not protected by FDIC insurance or bound by strict capital rules. That meant it could borrow aggressively to amplify bets, at times leveraging more than $30 of debt for every $1 of equity. Just a few percentage points of asset decline could wipe them out. Meanwhile, the U.S. government steadily loosened oversight, most notably repealing the Glass-Steagall Act in 1999, which blurred the line between investment and commercial banking. Wall Street's appetite for mortgage-linked products exploded. Warren Buffett famously called derivatives like these financial weapons of mass destruction. Lehman was among the most aggressive players. By 2007, Lehman was one of the largest issuers of mortgage-backed securities, sitting on a vast real estate portfolio. Profits soared, and its stock peaked near $86 per share. Inside Lehman, confidence, even hubris, reigned. Many believed they were the smartest guys in the room, but beneath the glossy numbers ticked a time bomb. A mountain of risky subprime mortgages and an over-leveraged balance sheet. When U.S. housing prices began to stall and fall, those risk-spreading products turned into loss-amplifying bombs. And when confidence cracked, the empire would face a brutal reckoning. Origins. When greed meets blind confidence in the early 2000s, America was swept by a historic housing boom. After the dot-com crash and 9/11s, interest rates dropped, making home loans cheap. Banks, including Lehman, flooded the market with subprime mortgages, loans to borrowers with weak repayment ability. The strategy wasn't to hold these risky loans, but to package and sell them as securities to investors worldwide. It was a gold mine. Turn risk into product, profit instantly. Lehman thrived. Executives believed risk was diversified and U.S. housing would never fall nationwide. CEO Richard Fuld, a hard-driving leader in power for decades, became an icon of Wall Street bravado, known for ignoring internal warnings about risk in pursuit of short-term gains. The Ascent, a profit machine on steroids from 2003 to 2006, Lehman soared. Mortgage and commercial real estate trading made it the fourth largest U.S. investment bank. Its leverage climbed above 30 to 1, meaning a tiny price drop could vaporize equity. Unlike rivals who quietly offloaded toxic assets, Lehman kept stacking them. Fuld believed long-term value would return. But Wall Street had built a giant Jenga tower, banks lending to each other, complex derivatives layered like glass towers, all assuming U.S. home prices couldn't fall nationwide. One crack would trigger a chain collapse. The breaking point. Bubble bursts by 2006, housing cooled. In 2007, prices slid broadly. Subprime borrowers defaulted en masse, nooking the very securities Lehman owned in bulk. Quarterly reports turned blood red. Investors panicked. Lehman stock plunged. Summer 2008, credit markets froze. Lehman, reliant on short-term funding, was cut off. In Q2 2008, it posted a $4 billion loss. Shares collapsed from $86 to under $4. Talks for a rescue began, but no one wanted Lehman's toxic mortgage pile. September 13th to 14th, 2008, U.S. Treasury Secretary Henry Paulson and the Federal Reserve huddled with bank CEOs. Bear Stearns had been rescued months earlier, but this time Washington refused another taxpayer bailout, fearing moral hazard. Barclays and Bank of America backed out when no safety net was offered. September 15, 2008, Lehman Brothers filed for bankruptcy with $600 plus billion in debt, the largest in U.S. history. Images of employees exiting with cardboard boxes became a symbol of Wall Street's downfall. Global fallout. Contagion like a virus, markets imploded. Credit froze. Safe money market funds broke the buck. Banks stopped overnight lending. Global finance teetered on paralysis. The U.S. scrambled. It bailed out AIG for $180 billion, injected emergency liquidity, and launched the $700 billion TARP bailout. But confidence was shattered. Failed solutions and harsh lessons. Letting Lehman fail remains one of the most controversial policy calls ever. Many say the government underestimated systemic risk, turning panic into a global depression-scale shock. Afterward came sweeping reforms. The Dodd-Frank Act, 2010, tougher bank capital rules, stress tests. Yet critics argue systemic risk never disappeared, it just shifted into new shadows. Lehman's fall was not just a business story. It was an indictment of unchecked leverage, greed, and blind faith in complex finance. A single weekend decision reshaped the world. Looking back, the collapse of Lehman Brothers was not an isolated event. It was a new chapter in the recurring story of financial crises where greed, overconfidence, and weak oversight combined to inflate massive bubbles. The frightening truth is that even after 2008, many familiar patterns have continued to emerge, only wrapped in new, more sophisticated disguises. Familiar cycles. From tulip mania to Lehman, financial history is filled with examples. The tulip mania of 1637. The South Sea Bubble of 1720, the Great Depression of 1929, the dot-com bubble of 1995 to 2000, all follow a similar pattern. A new belief arises, rare tulips, promising new companies, real estate always goes up. Money floods in, prices soar, and investors believe they are being smart. Leverage grows, risk is ignored, and complex products are created to spread the risk. A small shock is enough to topple the entire system once confidence disappears. Lehman Brothers in 2008 was simply the most modern example, but the fundamental rules never changed. Even complex tools like CDOs and MBS were just upgraded versions of the promissory notes and exotic securities that have appeared for centuries. Shocking data. After 2008, bubbles didn't disappear after the crisis. Banks were forced to hold more capital, and markets came under tighter oversight. But cheap money, thanks to prolonged low interest rates, pushed global asset prices to unprecedented levels. Global debt, government, corporate, and household combined soared from about $173 trillion in 2008 to over $300 trillion by 2023. Housing markets in many countries, especially China, Canada, and the U.S., hit record highs, far outpacing average incomes. Complex derivatives and new financial engineering, such as corporate debt securitization and structured products, kept proliferating. Meanwhile, the rise of cryptocurrencies and fintech added a new layer of risk. Unregulated exchanges poorly backed stablecoins and the 2021 crypto bubble, with the collapse of FTX and Terra Luna, felt like a mini Lehman in the digital world. The recurring pattern of overconfidence economists call this the Minsky moment after Hyman Minsky. A period of stability gives confidence grows, gives investors take on bigger risks. Leverage builds rapidly, and complex products emerge to justify the risk. When asset prices stop rising or a shock hits, confidence evaporates, liquidity dries up, and collapse follows. Lehman in 2008 was a textbook Minsky moment. But look at the crypto crash of 2022 or the tech startup valuation wipeout after COVID-19. The script is playing out again, just with a new setting. Too big to fail. Still an unfinished debate after Lehman, the idea of being too big to fail sparked fierce debate. Giants like JPMorgan, Goldman Sachs, and Morgan Stanley survived and even grew stronger with government support. Many experts worry that risk is now more concentrated than before. If one megabank fails today, the shock could be even larger. Regulators introduced new measures, stress tests, higher capital requirements, but gaps remain. The shadow banking system, hedge funds, and peer-to-peer lending platforms often escape strict oversight. Why the Lehman story still matters. When new investors enter the market, or when governments pump stimulus money, the pain of past crises is often quickly forgotten. Lehman Brothers serves as a powerful reminder that market confidence is fragile. Leverage can turn profits into catastrophe overnight. Risk management is never a luxury. These principles apply not only to big banks but also to individual investors and startups. Financial cycles, from euphoria to collapse, are always lurking, ready to return whenever greed overtakes caution. The collapse of Lehman Brothers was not just a financial event. It was a mirror reflecting the true nature of markets and human behavior. Looking back, we clearly see familiar patterns: greed, overconfidence, and the blind belief that this time will be different. But history rarely is. From this story emerge three powerful lessons that anyone interested in finance and investing should remember. Lesson 1. Leverage is a double-edged sword. Lehman Brothers once pushed its leverage to more than 30 times its equity. When times were good, leverage turned small profits into huge gains. But when the market reversed, even a slight drop in asset values was enough to destroy the entire system. This is a stark warning for both major financial institutions and individual investors. There is no free profit when you borrow excessively. Any investment built too heavily on debt carries hidden danger. Lesson 2. Risk management must never be ignored. Inside Lehman, there were warnings about the danger of holding toxic mortgage assets, but they were dismissed under the pressure of short-term profits and overconfidence. This is a common disease of Wall Street and of many companies today, prioritizing immediate gains over long-term stability. Managers, investors, and regulators must remember that risk often builds slowly and silently, but when it erupts, there's no time to react. Lesson 3. Market confidence is fragile. The global financial system relies heavily on trust. As long as investors believed Lehman could pay its debts, funding flowed. But when confidence vanished, even a 158-year-old giant collapsed in just a few days. This is why regulators must be cautious with their messaging and actions. And for investors, never assume that any company is truly too big to fail. History shows no one is immortal. A warning for today. 15 years after Lehman, the financial world has changed, but new risks have emerged. Tech bubbles, cryptocurrencies, record-high global corporate debt, and emerging markets under pressure from high interest rates. The shadow banking system, financial institutions outside traditional banks, has grown rapidly but remains lightly regulated. It only takes a single confidence shock, as seen with the collapse of FTX or U.S. regional banks in 2023, to expose how fragile markets still are. This reminds us, no system is immune to crisis. Today's stability can be an illusion if it is built on excessive leverage and weak oversight. Call to action: if you are an investor, remember, always check how much leverage a company is using before you invest. Diversify your portfolio. Don't place blind faith in one sector or innovative product. Don't chase the crowd just because prices are rising fast. If you are a business leader or manager, prioritize sustainability, transparency, and risk management. Don't let short-term success blind you to long-term survival. And if you are simply someone who follows the economy, the Lehman Brothers story reminds us that financial literacy is the best shield against global shocks. Understanding market cycles and risk helps you avoid panic when the world shakes. The fall of Lehman Brothers is a warning siren. No institution is truly untouchable, and no bubble is ever safe. We may not be able to prevent every crisis, but we can prepare, reduce risk, and avoid repeating the mistakes of the past.